John Higgins, Mortgage One. Happy Monday. So last week, lots of numbers to digest. One of the bigger ones was the Fed's favorite gauge of inflation. That would be the PCE. That's the personal consumption expenditure. Came in at 2.5%. I think the market was overall pretty happy with that number. You can see from the graph that we're well off the highs that we saw post-COVID as far as inflation, but getting to the Fed's target of 2%, a bit of a struggle. We've been kind of stuck at or below 3% here for quite some time. We also got a jobs number out, came in much higher than expected at 228,000. We did have a bit of a negative revision for the previous month. The wage component number that came along with that was quite benign. So another number that I think the market was relatively happy with. We know in the real estate industry, we need people with jobs to buy homes. So that's a number that certainly is welcome on the real estate side. Another number we got out, another biggie, GDP. We did see that sink into the negative area. So that was a bit of a surprise for the market. We knew that GDP was going to come in lower. Tons of cross currents out there with regard to the economy, with tariffs and all that. Be interesting to see what happens in the second quarter as corporations have really started to reel back their corporate expenditures and capital X. So we'll keep an eye on that number. But all that being said, and what's behind us, now we've got Fed week. If you look at the chart here from the CME about the probability of a Fed cut, it has fallen and fallen and fallen as far as the probability to nearly zero. So don't look for a cut from the Fed this week. I think the Fed was quite happy to see that jobs number be a little bit more robust, take the pressure off them to not cut rates. That might be a little bit surprising in some respects. I know the administration is calling for cuts, but the Fed really wants to sit on the sideline here and kind of see where inflation is going on the backs of all these tariffs. And they're always, it seems to be late to the game. We'll see if that's the case this time. We know they didn't increase rates quick enough the last time. We'll see if they're going to be behind the eight ball as we move through the year here. So where does that leave our mortgage interest rates? So the last couple of weeks been up and down, as you can see on the chart. We did fall a little bit. We're still, just under 7% on 30-year fixed money, depending on the program and your client's credit score. So, not a ton of great news other than I can say, as we got closer to 420 on that 10-year treasury, we did break below that momentarily last week. Certainly, our rates are looking a little bit better than they were maybe a week and a half ago, but nothing to write home about. Caution your clients that with all the cross currents in the marketplace right now, with the tariffs, corporations not knowing kind of exactly what's happening and how they're going to handle it, we're going to see more volatility in the market, I'm sure, as the weeks go on here. We'll give you an update after the Fed meeting next week. Until then, have a great week.